Hello, it's Edukator Milenial. Let's broaden our horizon about earnings management. The terms of earnings management is well known in accounting, management, business, and many other related topics. But before we talk about earnings management later, it would be better to know what is earnings. If we talk about earnings, we can define it as the income that an individual or organization gains during a certain period. They can be found on a company's income statement and are used to measure the profitability of that company. So let's start to talk about earnings management. What is earnings management? Have you ever heard about it? Or do you know it? Yeah, it's the use of accounting techniques to produce financial statements that present an overly positive view of a company's business activities and financial position. And it's used as a practice followed by management of a company to influence the earnings reported in financial statements. It's executed to reach a set target and is different from managing the underlying business of the company. An earnings management strategy uses accounting methods to present an excessively positive view of a company's financial positions and flattening earnings. Somehow, in accounting, is methods of manipulating financial records to improve the appearance of the company's financial position. And for some companies, earnings management are used to present the appearance of consistent profit and to smooth earnings fluctuations. One of the most popular ways to manipulate financial records is to use an accounting policy that generates higher short-term earnings. So some people are pro, but on the other hand, some people are contra with this term or these methods because in earnings management, it's used by companies to flatten out earnings variations and present profit that are consistent each quarter or year. So the variation in earnings may be common for the operations of a large company, but they create doubts among investors as they prefer to invest in stocks of companies that show growth and stability. There are two types of earnings management. The first one is when a company adopts an accounting procedure that makes it appear the company is generating higher earnings over a short time period. And for instance, the Enron Corporation in December 2001. It's about collapse and bankruptcy. The company used fake holdings and off the books accounting principles to manipulate its balance sheet in order to hide the company's liabilities and inflate earnings. That's the Enron issues. And the second one, it's related to how company capitalized its costs. Rather than immediately recognizing costs as expense on its balance sheet, a company will capitalize costs as assets over a longer period of time. By delaying the recording of expenses, the company can inflate its profits at least for the short term. Yep, that's the capitalization cost. And we know that companies use earnings management to smooth out fluctuations in earnings and present more consistent profit each month, quarter, or year. And s- for sure, management can feel pressure to manage earnings by manipulating the company's accounting practices to meet financial expectation and keep the company's stock price up because many executives receive bonuses based on earnings performance and others may be eligible for stock options when the stock price increases. And many forms of earnings manipulation are eventually uncovered either by a CPA firm performing an audit or through required Securities and Exchange Commission's disclosures. How to debug earnings management? Financial statement manipulation comes in a variety of forms. Investors who know that to look for can sometimes detect earnings management by performing a financial statement analysis of a company's quarterly and annual reports. And here's some sign of company might be use earnings management techniques to distort its financial statement figures, like climbing revenue growth that doesn't come with a corresponding growth in cash flows, reporting increased earnings that only occur during the fiscal year's final quarter, expanding fixed assets beyond what is considered normal for the company and our industry, and exaggerating an asset's net worth by neglecting to use the correct depreciation schedule, and many more. Yep, that's all about earnings management for the basic knowledge. So hopefully it'll be usable for us. I'll be glad if you kind of like to support this channel to move into another level by subscribing, giving like, and share as much as possible. See ya.